I stumbled upon China's 117 tower recently. It is the world's sixth tallest skyscraper. From a distance, it's an architectural marvel that rivals anything you'd see in Dubai, Hong Kong, or New York. But up close, it tells a completely different story. This unfinished giant, with its exposed concrete skeleton, isn't just an eyesore, it's a symbol of China's debt crisis, which is so massive that it makes the Evergrande debacle look like small potatoes. All around the 117 tower, you'll find a graveyard of abandoned buildings that were supposed to attract businesses and wealth, but instead, they've been driving prosperity away for years. So what's the deal with China's debt crisis? Let me tell you, it's a tangled web of extravagance and reckless spending that's been brewing for years, as cities and provinces took on enormous debts to build infrastructure and boost their GDP. The problem is that these debts have now reached astronomical levels, and it's time to pay the piper. At the heart of this crisis are local government financing vehicles, LGFVs, which are companies set up by officials to get around rules that restrict their borrowing abilities. By the end of last year, outstanding LGFV bonds amounted to a whopping 13.6 trillion yuan, $2 trillion, which is about 40% of China's corporate bond market. But the real kicker? When you factor in all the shady, unofficial lending that's been going on, some estimates put the total debt closer to a mind-blowing 50 trillion yuan. In this video, we'll dive deep into China's debt crisis and explore how it could potentially send shockwaves through the global economy. We'll also examine the implications of this financial fiasco and what it means for the future. But why China is in such a huge debt in the first place? To understand why China is in such a huge debt in the first place, we need to look back at the country's economic history and the decisions that led to this point. China's rapid economic growth over the past few decades has been nothing short of impressive. Fueled by a combination of market-oriented reforms, massive investment in infrastructure, and a booming manufacturing sector, the country has become the world's second-largest economy. However, this growth came at a cost. To fuel its ambitious development plans, the Chinese government adopted a strategy of aggressive borrowing and spending. Local governments, eager to spur economic growth and climb the political ladder, took on massive amounts of debt to finance ambitious projects, such as highways, high-speed rail networks, airports, and, of course, those now infamous ghost cities filled with empty buildings. A crucial player in China's debt saga is the Local Government Financing Vehicle, LGFV, a tool used by local governments to bypass central government restrictions on borrowing. Essentially, LGFVs are companies established by local governments to raise funds for their infrastructure projects. These vehicles allowed local governments to keep their debt off the books, making it difficult for regulators to accurately assess the true scale of the problem. Over time, LGFVs became the primary source of funding for many local governments, which resulted in a massive buildup of debt across the country. By the end of 2020, LGFV outstanding bonds reached a staggering 13.6 trillion yuan, $2 trillion, or about 40% of China's corporate bond market. And that's just the official figure. When you include all the shadowy, off-the-books lending that's been happening, some estimates put the total debt at an astonishing 50 trillion yuan. Another factor contributing to China's debt crisis is the country's focus on risky investments and its overcapacity problem. To maintain high levels of economic growth, local governments and state-owned enterprises invested heavily in industries like steel, cement, and coal, creating an oversupply and driving down prices. This overcapacity led to lower returns on investment, which in turn made it harder for companies to service their debt. Simultaneously, local governments encouraged the development of speculative real estate projects, hoping that rising property prices would generate higher revenues. This led to the construction of numerous luxury residential complexes, shopping malls, and office buildings, many of which now stand empty or unfinished, a testament to the unsustainability of this growth model. The 2008 global financial crisis was a turning point for China's debt problem. In response to the crisis, the Chinese government launched a massive stimulus package, injecting 4 trillion yuan, $586 billion, into the economy to maintain growth and prevent job losses. While this move helped China weather the storm, it also further fueled the country's debt binge. as local governments and state-owned enterprises use the funds to finance even more ambitious projects. What are the implications of China's debt crisis on global economics? You see, China's economy is so massive and interconnected with the rest of the world that a crisis of this magnitude could send shockwaves across the globe, affecting everything from trade to investment. One major implication of China's debt crisis is the potential for a slowdown in its economic growth. As the world's second-largest economy, China has been a key driver of global growth for years, and any slowdown could have a domino effect on other countries, particularly those that heavily rely on trade with China. Export-driven economies in Asia, like South Korea, Japan, and Vietnam, could be hit hard, as they may see a decrease in demand for their products. Another aspect to consider is the impact on global investment. As Chinese companies and local governments struggle to pay off their debts, they'll likely cut back on investment in infrastructure and other projects. This could lead to a decrease in demand for commodities like steel, cement, and copper, which could, in turn, hurt countries that are major exporters of these resources, such as Australia, Brazil, and Chile. We also need to think about the potential ripple effect on global financial markets. A significant debt crisis in China could trigger a loss of confidence among investors, leading to a sell-off in global stock markets. This could then create a vicious cycle, where investor panic exacerbates the economic slowdown, which could then lead to even more panic. Furthermore, China's debt crisis could put pressure on its currency, the yuan. As the Chinese government tries to manage the crisis, they may be forced to devalue the yuan, making their exports cheaper and more competitive. While this may help China's export sector, it could also lead to a currency war, with other countries devaluing their currencies to stay competitive. This scenario could destabilize the global economy and potentially trigger a new wave of protectionism. It's essential to recognize that China's debt crisis is not happening in a vacuum. The global economy is still recovering from the COVID-19 pandemic, and any additional economic stressors could slow down or even reverse the progress we've made so far. So, what does China's debt crisis mean for the future? Well, it's a bit tricky to predict exactly how things will pan out, but we can certainly explore some possibilities. Firstly, China might take some drastic measures to get its debt under control. This could involve restructuring its financial system, cracking down on shadow banking, or implementing more stringent regulations for local governments and their borrowing habits. These actions might help stabilize the situation in the short term, but they could also result in slower economic growth for China. Now, while slower growth might sound like bad news, it's not all doom and gloom. It's essential to remember that China has been growing at breakneck speed for decades, so a bit of a slowdown might not be the worst thing. In fact, it could give the Chinese government an opportunity to focus on more sustainable, long-term growth strategies, like investing in green technologies or improving social welfare programs. As for the rest of the world, well, we may need to brace ourselves for some economic turbulence. If China's debt crisis impacts global trade, investment, and financial markets, it's likely that we'll all feel the effects to some extent. This might mean adjusting our own economic policies, diversifying trade partnerships, and finding ways to bolster our own economies against external shocks. But hey, let's not get too pessimistic. Throughout history, economies have faced numerous challenges and managed to adapt and overcome them. If anything, China's debt crisis could serve as a wake-up call for the global community, reminding us of the importance of financial prudence and responsible economic management. So, while the future may be uncertain, there's still a lot we can learn from this situation. As we navigate these uncharted waters together, we can use the lessons of China's debt crisis to forge a more resilient, sustainable, and equitable global economy. After all, it's in times like these that we truly discover our capacity for growth, innovation, and collaboration.